Dividend stocks versus growth stocks is one of the biggest investing debates heading into 2026, and the truth is, most investors are thinking about it the wrong way. Some people believe dividends are only for retirees, while others think growth stocks are the only way to build real wealth. But when you actually look at history, market cycles, and what's happening in the economy right now, the real winner depends on how and when you invest, not just what you invest in. Dividend stocks are companies that regularly pay shareholders a portion of their profits, usually quarterly. These tend to be mature, profitable businesses like consumer staples, utilities, healthcare companies, and established financial firms. Investors are drawn to dividend stocks because they provide predictable income, lower volatility, and psychological comfort during market downturns. In uncertain or sideways markets, dividends act like a paycheck that keeps coming even when prices aren't moving much. Historically, dividend-paying stocks have also made up a large portion of total market returns over long periods due to reinvestment and compounding. Growth stocks, on the other hand, are companies that reinvest most or all of their profits back into the business to expand faster. Think technology, artificial intelligence, cloud computing, biotech, and emerging industries. These companies usually pay little or no dividends because their goal is rapid expansion. Growth stocks shine when interest rates are falling, innovation is accelerating, and investors are willing to take on more risk. Over long periods, growth stocks have produced massive gains, but with much higher volatility and sharper drawdowns along the way. So heading into 2026, what actually gives one side the edge? The key factor is the economic environment. If inflation stays moderate and interest rates gradually decline or stabilize, growth stocks could regain leadership, especially in sectors like AI, automation, and advanced software. Lower rates make future earnings more valuable, which benefits growth companies the most. However, if economic growth slows, volatility increases, or markets move sideways, dividend stocks tend to outperform on a risk-adjusted basis because investors value cash flow and stability. Another critical difference is how these strategies feel to hold. Growth investing requires patience and emotional discipline. You could be right long-term and still experience brutal short-term losses. Dividend investing, meanwhile, rewards consistency and behavior. When dividends are reinvested, especially during market downturns, investors buy more shares at lower prices, which accelerates long-term compounding. Many investors underestimate how powerful this effect becomes over decades, not years. Looking at historical data, neither strategy wins all the time. Growth stocks dominated much of the 2010s, while dividend and value stocks performed better during periods of higher inflation, rising rates, or economic uncertainty. This rotation is normal. Markets move in cycles, and betting entirely on one style exposes investors to unnecessary risk. For most investors in 2026, the smartest move isn't dividend stocks or growth stocks. It's dividend stocks and growth stocks. A balanced approach allows you to capture upside during bull markets while still generating income and stability when markets pull back. Growth provides acceleration, dividends provide resilience, and together they smooth out returns and reduce emotional decision-making. This is especially important for younger investors who want long-term growth, but also need discipline to stay invested through downturns. So who really wins in 2026? Dividend stocks or growth stocks? The real winner is the investor who understands the role each plays and builds a portfolio that works in multiple market environments. Growth builds wealth, dividends protect it, and time does the rest. If you can stay consistent, reinvest, and avoid chasing whatever's hot in the moment, you don't need to predict the future. You just need to participate in it.